the idea that I could embed a contract in an asset and have certain clauses of that contract self-execute, that just blew my mind.
In the near future, we'll see clients, users, investors actually holding DeFi wallets instead of accounts, which could hold assets across multiple chains, across multiple protocols.
It may take us 20 years to get rid of accounts, but I would say that within the next 5 years, you're going to see more and more financial activity taking place on-chain.
Sandy Kaul is the head of innovation at Franklin Templeton, the $1.7 trillion global asset manager. Sandy has a clear focus on tokenization, not as an experiment, but as real on-chain products, including going live with the first tokenized money market fund in the world. Are you seeing a more multi-chain future for your tokenization drive?
There's going to be multiple chains that are going to each kind of serve unique use cases. Success is when they don't even understand that the underlying way that their portfolio is being delivered has shifted. And that is really where all of this has to begin.
Hello, Sandy, and welcome to Alpha on Hash.
Thank you so much for having me.
So, Sandy, when you had innovation for a 1.7 trillion behemoth, Franklin Templeton, and one of the early TradFi institutions, I think I'd say, along with Fidelity, who've been really focused on blockchain, and not just as a theory and experiment, but really getting on chain. So can you give me a little bit of the backstory? How did this whole tokenization on-chain drive DNA come about at Franklin Templeton?
Yeah, so I think two really interesting things about Franklin Templeton is number one, even though we are a public company, the same family established the company and has led the company since our initiation, which was over 80 years ago. So in many ways, we are a family-run company. So our CEO, Jenny Johnson, is the third generation of her family to be running Franklin Templeton. And so she brings to that CEO role this sense of multi-generation thinking, right? And she really feels a great responsibility to make sure that she runs the company in a way that the fourth generation and fifth generation of her families will also be in a position to inherit a very thriving business. So she thinks more long term, I think, than many CEOs. And on her journey, she really worked her way up through many different roles at Franklin Templeton, one of which she ran tech and ops. So she really understands technology and really understands how to build in new technologies. And we had been doing our own transfer agency work, and transfer agents basically keep the shareholder record, right? So not the record of what securities does a fund own, but the records of whether you own the fund, I own the fund, right? And that's a very ledger intensive business, right? We have thousands of mutual funds. Therefore, we have thousands of shareholder records that we update every single day. And when blockchain came out, Jenny said, I really want to explore whether blockchain can help me in this efficiencies around record keeping. And we needed to launch a fund on blockchain to be able to test that. So we filed all the way back in 2019 with the Securities Exchange Commission in the US, and we launched our first tokenized money market fund in April of 2021. And that fund has been running 24/7 on chain since April. So we're going on 5 years there. We did a side-by-side pilot with the SEC that allowed us to show the blockchain-based transfer agencies efficiency next to our traditional mainframe-based transfer agent system. We did that side-by-side pilot for over 6 months. We ran over 50,000 transactions, and the blockchain-based system operated so much more cost effectively and was so much more accurate that we got permission from the Securities Exchange Commission to run our tokenized money market fund solely as a digital native. So many of the offerings in the market today are digital twins, where the shares that represent actual ownership of the fund are off-chain, And all you have
Mm.
on chain is kind of almost a warehouse receipt that says you own the fund. Whereas our tokenized money market fund, your token is the actual exposure, and therefore we run our fund as a digital native.
Okay. And this was the first money market fund to be to have got the approval to be launched.
Yep.
Okay.
First ever in
And
the world, I think. I think it was the first in the
yeah.
world.
Right. Okay. And Franklin obviously has a deep legacy in, especially in money market funds, right? From what I understand, was the first, one of the first to issue a money market fund, and one of the first to reach $1 billion AUM. Way back several decades ago. So it seemed like a very logical extension as a product on chain.
Yeah, and one of the other interesting things about Franklin Templeton is that they've always had this idea of democratization around investing.
Mhm.
And so, they were the first to come out with what was at the time a very low subscription threshold of $500 a share. With our tokenized money market fund that we launched, we were able to launch that in the US with a subscription size of only $20 a share.
Mhm.
So we're able to really use these blockchain rails to make accessibility to our money market fund much more broad based.
Right. No, so you've touched upon something which is of sort of core importance to this whole tokenization narrative. There's been a lot of talk around getting everything on chain. I'm not sure, though I'd love for that to happen. I'm not sure that really makes sense for several asset classes. In fact. But tokenization really brings in multiple efficiencies into certain very specific or large sections of the sort of financial market. So can you run us through, your view on what are these real efficiencies that you've seen tokenization bring about? You touched upon one, which is democratization through fractionalization broadly. Fractionalization has always been there, but at scale is only possible now with blockchain.
Yes.
So, would love to understand all the different dimensions, and also I mean, the way the Franklin Templeton Money Market Fund has been on chain, where the ownership ledger is actually on chain. That clearly is a distinction from just how many of the RWAs are tokenized. So that, but along with that, what else is sort of the view on why tokenization?
Yeah. So this is where I'm the most excited to be, because this is where we're actually starting to change the system, right?
Hmm.
So today, a traditional money market fund and tokenized money market funds that are digital twins, um, you have to wait for the off-chain shares to settle to update the ownership record, right? And that's
Hmm.
typically the next trade day. So
Yeah.
if I buy a money market fund on a Friday, I don't really own that money market fund until Monday. Because
Mm.
we are a digitally native product, every time a block settles on the blockchain, we update the shareholder record. So we are instantly updating the shareholder record at block speed, and we are deployed across 10 different public blockchains. So we are basically, every time a block updates on any of those 10 blockchains, we are updating our shareholder record, which gives us a real time view of who owns the fund. And this is critical because today, in a tokenized money market fund from our competitors and in traditional money market funds, you only are entitled to the yield on that money market fund if you own the fund at the close, right? So with our money
Mm.
market fund, if you owned it at midnight and you sold it to me at noon, and I owned it for the other half of the day, because we are keeping real-time records, we are able to split the yield on the day. So you would get
Okay.
half the yield and I would get half the
Mm.
yield, which is a much more accurate depiction of what's going on in the fund. And if you're a big corporate treasurer and you're managing billions of dollars, that intraday yield actually can
Mm.
amount to very significant sums. The second thing we were able to do is in our competitors' products and in a traditional money market fund, they accumulate your daily yield and they only pay it out to you once a month, right? In ours, we pay out incremental yield every single calendar day of the year, including Saturdays, Sundays, and holidays. And we drop that yield directly into your wallet in the form of new token issuance. And then the
Okay.
third, I think, really amazing innovation that we've been able to do by running a digitally native product is that we have enabled peer-to-peer transferability across
Mhm.
any wallet that has been set up in our system and any wallet it's connected to, right? So we set you up in our system. If you're doing self-custody, we have linked your self-custody wallet to our system so that if, God forbid, anything ever happened to your tokenized money market fund, we can cancel and replace your tokens, right?
Mhm.
So you could transfer your money market funds to any other entity that is set up in the network. So if you think about the institutional use cases or the corporate use cases, right? They have legal entities all over the world, or a venture capital fund has portfolio companies that are very diversified. You can actually manage your own tokenized money market fund tokens and distribute them within your own network that we can set up for you without having to go through any intermediary activities or steps, right? There's peer-to-peer transferability across the whole network.
Right. And you mentioned about you touched on identity briefly. So is this and it's all it's tokenized on 10 public chains already, but do you need to be KYC'd? The wallets need to be KYC'd before they can access the fund, or does it
Ah,
work completely natively like DeFi?
yeah, no, we're not quite at the DeFi level yet. These are still regulated funds. We work with regulators. Right now, we're working with regulators in 4 different jurisdictions, and that just continues to expand. So we cannot get around the KYC AML requirements because these are regulated funds. Now, that said, we are exploring some of these new vault-based structures where we can put those funds into a vault and then issue tokens on top of the vault to give more accessibility in a permissionless form for use in DeFi, which is a newer model that we're now starting to explore and move toward. But this actual tokenized money market fund is still a registered product, and we have to be able to do KYC AML.
Okay, all right. So very clear sort of view on why tokenization, especially for something like a money market fund. What's the uh, even bigger picture than that? So what all would you like to get on chain?
Yeah, so I think that our belief is that you're going to have portfolios in the future that are going to span traditional products, crypto products, new products that aren't even tokenized yet, that are coming into play. Things like having IP rights to different, art or music or film or video, right? We think that there's going to be a whole range of assets that are going to sit in a wallet. And
Hmm.
we have seen those crypto wallets. We're starting to see some DeFi tokens that sit in wallets alongside. And what we're doing over the next 12 months is we will be bringing a whole set of registered and, security, registered tokens. Let me say that again. And over the next 12 months, we're going to be bringing in a whole set of tokenized real world asset funds that will be available on chain that can bring in some higher structured yield type returns, that can bring in some ETF type returns for high liquidity and getting different types of exposures. Like, for example, we have a socially responsible gold ETF where all of the gold mining that's being done there is being done in a very environmentally focused way, right? So we think that there's some interesting traditional investment products that people will want to hold in their wallets, and we'll be
Hmm.
bringing those products on chain. And really diversifying our set of funds that we offer on chain. That's going to be, I think, the focus for the next 12 months.
Okay, all right. And what's the thinking around composability? For example, can you take and we when we say the money market fund, we're talking about the Benji
Yes.
or and Fob XX. How are they sort of related? Can you just explain for everybody?
Yeah, so Benji is our name for our overall suite of money market funds. So we have four different versions to go back to. This is because of those regulatory jurisdictions. So we have a US version that is a US 40 Act company. We have a UCITS version, which is a CCAV company out of Luxembourg. We have a VCC structure, which is out of Singapore. And then we have a private fund that is really targeted at institutional collateral use cases. So we have those four versions of the Benji fund, but they all refer to the same underlying investment fund and investment strategy. They're just different representations for a regulatory compliance purpose, right? So depending on your jurisdiction, you may need to be using different of these funds, and there's different regulatory reporting that we need to do around that. And as we expand our product suite, we do this all based on smart contracts. So our smart contracts are in the blockchain, different blockchain languages. We're programming across all four major blockchain languages. We are using and basing these off of the templates that are being broadly used in the system so that they can be composable and interoperable. And so what we're trying to do is bring our TradFi expertise into the actual delivery mechanisms of the blockchain ecosystem.
All right, so that's fantastic. And today, can the money market fund token be used as collateral, for example, on say Aave or Morpho or any of the lending platforms, and is that part of the plan? What's status currently, and how are you thinking about it going ahead?
Yes. So what we've done first is we've developed what we call are these collateral mirroring programs so that they can be used as collateral on the crypto derivative exchanges for initial and variation margin on the initial crypto exchanges for derivatives. We are next working on figuring out our solution that meets regulatory requirements for us to be able to move these tokens into the more DeFi venues such as Aave and Morphos, as you noted. That's kind of our next horizon, is how do we then create the right structures and the right controls to allow us to get into the DeFi pools. And that is also very much on our roadmap. That is something we're very excited about.
No, this is all it feels to me like I'm having a conversation like my usual guests who are from more DeFi native, but but to have somebody from Franklin Templeton talking the same narrative language and the same sort of design principles like us from the DeFi world is just sort of seeing the convergence of TradFi and DeFi, which everybody believed would happen. And not in many ways, the vectors of how it's happening are probably a bit different, but it's fascinating to see that. You also spoke about 10 different chains which you're on. Uh, what's sort of the internal view at sort of Franklin Templeton, and especially now, when there's a lot more talk around concentration on Ethereum, after the last upgrade, for example, where gas costs and everything has really gone down. What's the view? Are you seeing a more multi-chain future for your tokenization drive, or it's going to converge onto one or two broad chains?
Yeah, I don't think we're ever going to only have one or two chains, right? I think that, there's different use cases for different chains, and we're already seeing this in the way that we're operating today, right? It depends on the nature of the order, right? We have had developed a pretty extensive order routing set of intelligence that really thinks about who is the client, who is the order, what is the order, what is the size of the order, what is the expected duration based on the client type. And so, just to make it super simple, if it's me, Sandy, and I'm putting in an order, I might want to put that onto a chain that has a very low processing cost and maybe not as high a security as something like an Ethereum. right? Whereas
Mm.
if I'm putting in a trade for, one of the sovereign wealth funds that is really managing assets on behalf of their population, and they are likely to have a very long-term view in their position holdings, well, then I might want to pay the extra to get it onto one of the more highly secure chains where I'm going to have more confidence that that is going to be a long-term record that they're going to really be able to manage. Right. So, I mean, we envision a world where our tokenized money market fund, because it is fractionable down to a penny, right? I might want to use my tokenized money market fund to pay for a cup of coffee, right? That person is likely to we're likely to put those trades for that person on a very different chain than
Mm.
for a big institution. So I think that there's going to be multiple chains that are going to each kind of serve unique use cases. I don't think it's going to be 20, 30, 40 chains. It's probably going to be somewhere in the 5 to 10 range to really operate the global financial system. But I do think that being able to operate cross chain, being able to really understand the complexities of multi chain record keeping, that's going to be a very important skill set in the future.
Okay. So multi-chain, multiple assets, use cases as well, depending upon who the investor is, if it's a large institutional investor versus retail. And that thinking is pretty comprehensive in how you're kind of thinking through this. Of course, it's the space is so evolving all the time, so we'll see how actually things pan out. But interesting to sort of note the whole sort of design framework that a large institution like Franklin Templeton is. One of the barriers that many have spoken about for Wall Street getting on chain is privacy. It's sort of at odds with the very tenet of on-chain transparency with which blockchain and DeFi has evolved. But privacy in the financial domain is also a critical property. So, how are you thinking about that? And is this something that will become an important decision framework for you?
Yeah, privacy is still a big concern, particularly when you get to very large institutional players. And in fact, that is why we've also had to deploy our entire system across a private blockchain as well, because they wanted that privacy. But I do think that this is going to be solved in a way that surprises people, because I think that it's going to be solved through an updating of the know your customer anti-money laundering rules to really reflect the 21st century system, not the 20th century system. And by that, I mean that, I should not have to expose my identity except when I am actually enacting a transaction. Right. So just like we use keys today to sign for a wallet transaction, when I use my key to sign, that is the moment in which I should be given a KYC AML screen, right? And if I can be evaluated in that moment, which is really going to be required because the speed at which all of these transactions are going to be taking place is going to become so extreme, we're not going to be able to keep up with it at a human nature, right? But the transactions can be screened at the point of event, right? So I think we're going to move from I set up your KYC AML credentials and they only get updated once a year or so to one where every time you actually do a transaction, I'm able to screen you in that moment to determine whether you're qualified to do that transaction. And I think that is how we're going to open up this system to the entire set of the 100 trillion currently under management.
Okay, all right, and which we're probably talking something like ZK here, and is this something that you're also working on native? I mean, internally, or is it something that you look at sort of the larger blockchain infrastructure to evolve into?
Yeah, we're looking at the blockchain infrastructure. We're looking at some really innovative new projects that are emerging. And then we're also, experimenting internally as well. This is one that the regulators need to lead, but the regulators
Mm.
also look to us as a very well-known entity to give them suggestions and to help them shape their thinking. And so part of the reason we're looking at this is simply to understand what's possible, to help the regulators understand what's possible so that they can really think about this system in the way that honors the technology the most and really opens up the potential the most.
Okay, all right. And you touched upon sort of the intensity of transactions, and one of the sort of broad thesis that Franklin Templeton, I think, has espoused is also around the convergence of AI, agentic frameworks, and DeFi, which again is sort of very interesting to hear from a large institution. So, can you share your thoughts on what's the real thinking around there, and sort of what are you doing about that currently?
Yeah, and I think it starts even before we get to the DeFi portion of it, right? We're looking at the AI agentive technology in a few different ways, right? For order routing, I talked before about order routing and which chain we're going to be thinking about for routing orders. We're using AI agentive technology to be doing compliance checks and wallet checks with the blockchains, where we're looking to only operate with whitelisted wallets because we actually also run our own node operations on the chains where we're able, because we think that's a critical part of doing our due diligence and record keeping. So we're using that in doing the screens on the transactions that we're able to accept. We're
Okay.
doing AI agentive technology and are thinking about how do we build the trade profile of the investor and the underlying assets that are being traded in the fund, and the qualifications as to those investors with those assets, right? Because we're operating a system that works globally 24/7. And then as we start to move out of enabling the trade, we're starting to look at this from our risk management perspective. We're starting to look at this as our performance management perspective. And then once we get outside of our walls, this is when we're starting to now really think about, okay, now how do we bring it into the ecosystem? And how do we bring it into the different protocols where we might be being asked to be used in a payment workflow or in a DeFi workflow? And that's kind of where we're starting to do our thinking now. We've kind of focused on using these technologies to really enhance the way we operate this platform internally first, to make sure that we're really taking advantage of this. And it's been really fascinating to see, the progression of the team, and how quickly they're able to really integrate and bring in this thinking. And the combination of AI agentive technologies and smart contracts, I just think is so powerful in what can be done with it. And I think we're just at the very, very tip of the iceberg and thinking about that.
Right. So very quite clearly, there's so many use cases for agentic framework, especially a framework which has either humans in the loop or clear policies, guardrails outlined, so we don't have runaway agents as well.
Yeah.
And I'm sure, so it's going to be a very interesting sort of fast-paced change that will come about, not just as you said in DeFi, but in financial markets as such. Now, all of these vectors together are going to impact the entire asset management industry itself, right? What is your thinking around that? Asset management currently in a very niche, if I were to use the word in that context, as far as where treasuries and money market funds getting tokenized and being issued on chain is one aspect of it, but the entire asset management stack can be on chain, disintermediated, and with a very strong convergence with AI agentic frameworks as well. So, do you see the entire a structural change in the asset management industry as it stands today over the next few years?
100%, right? I think that, right, the entire global financial market infrastructure today, Sri, is built on technology that really came out in the 1970s. And we've updated it marginally around the edges, but not really, right? The whole system operates in a way that was cutting edge for 1970, but not looking so cutting edge in the 2020s, right? So I think we need to build this 21st century financial market infrastructure. And this is where I think we're starting to finally see the first signs of change, right? In the US, the Securities Exchange Commission gave a no action letter to the Depository Trust Company, and we're going to be able in 2026 to begin to request that already traded shares, so post trade shares, can be tokenized and held in a wallet. It feels like an incremental step, but it's critical because it's actually introducing wallet technology into the financial market infrastructure. And that is really where all of this has to begin. If there's not wallets, we can't do anything else. So we have to start with wallets. So this is a critical change. You've seen the New York Stock Exchange announce that they are going to be enabling 24/7 trading for the first time. Now, again, these are still going to be off-chain shares that are represented on chain, but it is, again, a critical step because it's really starting to position people to get used to this idea of a pre-funded account where a transaction can settle atomically, where the assets and the payments move immediately. That is not the way today's financial system operates. So getting to these models, even if they're just incremental steps now, these are critical movement along the chain that's going to take us to the entire architecture being re-platformed onto these rails. So I think that we've seen some major steps in the past year, and we will start to see the impacts of that later this year, 2026, when we start to see tokenized equities, tokenized US government bonds, tokenized corporate bonds coming out of the US. And even though those will be digital twins, that's still a major movement from where we were even just a year ago.
Right. So it's in the pretty much the near future, we'll see clients, users, investors actually holding wallets instead of accounts, and probably wallets which are like any DeFi wallet, that they could hold assets across multiple chains, across multiple protocols. In this case, asset managers issuing tokenized structure products. So that's one thing which is quite likely to happen. The other thing quite likely to happen is sort of the native issuance of structured products directly on chain, and all settlements obviously happening now on chain. So the entire custody framework, the entire intermediary framework which exists in the whole asset management stack today can be completely upended probably in the near future.
Yeah, and unfortunately for a while it's going to be an all of the above world, because there's still going to be legacy accounts, there's still going to be this new set of wallets, and we're going to have to orchestrate across both those ecosystems. It may take us 20 years to get rid of accounts, but I would say that within the next 5 years, you're going to see more and more financial activity taking place on chain. And as you said, it's going to be through these digital twins, but also a growing set of digitally native issued products on chain. And that's where I think the future really sits for the industry.
We've spoken a lot about taking current financial asset structured products on chain. What about the reverse flow? Now, DeFi markets have really evolved and are maturing, and there are very innovative products. For example, a money market fund generating 3-4% versus DeFi yield being double of that, even in a safe DeFi framework today, not really sort of with highly risky underlying assets and stuff. Okay. Or with token emissions, but actual stablecoin based yields being double of that. So is there a thinking around making DeFi structured yield products accessible to current off-chain users off-chain investors, your user base, giving them exposure to that?
Yeah, absolutely. We're looking to solve, though, a couple issues that make it hard for a regulated player to do that. The primary one being that when an asset enters a DeFi pool, the official listed owner becomes unclear, right? And we, as an issuer of these on chain digitally native securities, have to be able to show a continual chain of ownership to prove that we have control of the asset, right? The blockchain is still being established as what they call in regulatory speak a good control location. And therefore, we can't lose the designated owner and the proof that that designated owner has met KYC AML compliant requirements when an asset is put into a DeFi pool as it exists today for regulated assets. So this is something that we're looking to solve. We have a few ideas there on how to do that that will allow us to have more activity in these pools. But that's just one example of the issues that we need to be able to prove to regulators that we have workable solutions for and demonstrable solutions for to be able to put these assets into DeFi. Now, I think that this is eminently solvable. We just need to kind of get the regulators on board with our thinking about how we're going to approach that.
Okay, all right. Um, how, as a large money market fund, operator, uh, at some point you would have seen stable coins as conflict, especially yield bearing stable coins, and there is also a convergence of both these sort of asset classes. If I were to also look at stable coin, yield bearing stable coins as an asset class as well. So how do you see them, and how are these going to be touching each other? What are the touch points? What could be the sources of conflict, and where they converge? Some broad thoughts on that.
Yeah. So I think that, look, you always have use cases where you need cash, and then you have use cases where you need something with a guaranteed yield coming off the back of it. And I think that stable coins and tokenized money market funds will coexist. I think that this idea of a yield bearing stable coin, I think it's going to come down to how is it being used, right? If the stable coin is being used as cash, it should
Mm,
not be paying a yield, right? If the stable coin is being used as a savings vehicle, it might pay yield, but that yield cannot be guaranteed. And if a stable coin is paying yield and guaranteeing a yield, even if they call it a reward, it's actually a
mm,
security, right? So it's an investment contract. And so if you think of them as a spectrum, right,
mm,
I think that there's going to be use cases for all of them, and that these differentials will start to come into play. I mean, look, in the off-chain world, you can have a checking account that's just cash. You can have a savings account where you get paid some interest, which is really to me the equivalent of the rewards programs that the stablecoins are doing today. But then you also have a money market fund backed account where that yield is guaranteed to be paid to you every single day, and it is backed by the guarantees of the regulators and the consumer protections of it being a regulated security. So I think that you're going to see all three use cases. We plan on participating with all three instruments and all three designations. I think that the way liquidity moves in the blockchain ecosystem is becoming more and more intertwined. We call it the universal liquidity layer because I should be able to seamlessly go between stable coins, tokenized money market funds, tokenized deposits, central bank digital currencies, tokenized gold, any product that has a regularly valuable and transparent ability to prove its valuation is going to become part of this universal liquidity layer, and enabling all of this interoperability across these forms of payments is really how we unlock the ability to grow the system. So I'm very positive about the future for both tokenized money market funds and stablecoins.
okay, all right. Though you also touched upon um, the current structure that exists, for example, the analogy of a savings account and a checking account, um, those were all again designed, decades back, and they kind of served a purpose. Mostly right. Some in some cases they might have had issues. Why do we need to replicate almost that same structure in this new, completely new world of DeFi or on-chain finance?
Yeah.
Isn't there a
Oh, no, go ahead. I'm sorry, I didn't mean to cut you off.
No, you got the drift of what I'm trying to ask, so please go ahead.
Yeah, because I think that the way that you maximize the buying power of your cash really
Mm,
comes down to your ability to capture yield on that cash every second that is possible and maximize that yield. So to go back to DeFi, right? You want to be able to make your cash work as effectively as possible. And
mm,
in the off chain system, that is done through these overnight sweeps. That's done through
mm,
repo trading, right? Things that require kind of an overnight minimum, sometimes over weekend, over holiday, time lag, right? But the concept translates exactly to the blockchain based ecosystem. I still want to maximize the utilization of my cash at every instant. And my options for how to do that are now moving at the speed of the chain, and they are multiplying. And so building this interoperability and this ability to deploy cash, I don't want it to be in its pure cash form, except for the actual second I am paying for something. And other than that actual second, it should be being deployed into other vehicles that offer that yield and maximize that yield. And that is really, I think, the mentality that people need to take, is that cash is fuel, but cash does not by itself feed anything. You need to feed the system through yield, and yield comes by the effective deployment of cash. So I think that that concept carries over directly from the traditional financial world. It's just the tools to do it are better now, and the way that we can manage it is moving faster now.
okay. So Sandy, from the width of this conversation that we've been having, I'm um, I'm compelled to ask you, when did you get orange pilled? With
I love that question. I heard about Bitcoin and blockchain. First I heard of it was in 2013. And
Mhm,
I was fascinated, but was having trouble thinking about where does it fit in the financial world.
mm,
I got my orange pilled, as you say, when the Ethereum network came out, and I first learned about smart contracts. Um, there is such an issue in the traditional financial world, where we have contracts governing transactions so
mm,
separate, usually in PDFs, if we're lucky,
mm.
from
Yeah.
the actual transactions they govern. And the need to reconcile between contracts and transactions adds sometimes 2, 3, 4 days of processing
Mm,
time into the system. That the idea that I could embed a contract in an asset and have certain clauses of that contract self execute, that just blew my mind. That was the moment
mhm,
I was like, oh my God, this is going to change everything.
mhm. All right. And so let's say that was around 13, 15, okay, thereabouts. And then you mentioned about uh, the current chairperson, Jenny Johnson,
Yep.
being herself, and she had probably also an orange pill moment, or was that gradually? Did the senior team, take blockchain as a foundational technology, and these discussions happen? How did all of that sort of happen? I know we touched upon this when we began the conversation, but would love to get a little bit deeper into that.
Yeah. So that's actually a really fun story, because I was not at Franklin Templeton when I was having these realizations. I was at Citibank, and I was leading a thought leadership practice. And so
Mm,
at the beginning of 2018, I published a paper that was entitled Tokenization Will Replace Equities and Bonds Over Time.
Okay.
And you can imagine this was not a very popular point of view in 2018, the beginning of 2018. It was really the end of 2017.
Mm.
And I had a CEO luncheon to launch that paper, and Jenny was sitting next to me at the luncheon. And she said, "Hey, I've got my team in Franklin really telling me that this blockchain is something big, that I should really be focusing on this blockchain. And now you're coming out with this paper. Do you think they're
Mm.
right?" And I was like, "Absolutely, they're right. You should totally be starting to experiment with this blockchain." And
Mm.
so, I do feel that even though I wasn't at Franklin Templeton, that I helped to really launch the practice that we're now all leading together. But yeah, so that was really how that happened. And it was such a litmus test back then because so many firms, even firms today that are at the forefront of pushing for tokenization, they were very negative on that point of view and they
Yeah.
really, a lot of people thought I was being crazy and suggesting this and squandering some of my credibility. So it's always nice to be proved right in the end.
No, that's really a sort of interesting story. And looking ahead, if you were to kind of stargaze and come up with a 10-year horizon, over a 10-year horizon, how the future of large financial institutions and financial markets is going to be, shed some light on that.
Yeah. So we already have been moving away from the traditional fund structures that have really defined financial services for the last 50 years. And we've been moving portfolios into separately managed accounts. So instead of you and I being in a big commingled fund, we're in our own account where we own those securities directly. And this is allowing us to start to do some tax optimization, some personal alignment based on some of the values that I might hold as an individual, right? So that's already a major shift in how asset management works. I fully expect those separately managed accounts to migrate into vaults. And you and I will each have our own vault. Our vault will contain the wallet that we own. Our assets will be in that wallet, and we will be able to optimize within our own vault all of the different assets we hold and really start to put each asset to work in a way that hasn't been possible. Put it to work in terms of earning rewards, right? Put it to work in terms of earning additional yield, put it to work in terms of earning additional fees, right? And we will be able to contribute our own assets into our own portfolio. There's no reason why I should not be able to put the equity that I have in my home. No reason that I shouldn't be able to put any art that I might own. No reason I shouldn't be able to put the IP I'm creating if I'm an influencer into my own personal investment vault and be able to use that as an asset in DeFi protocols or in staking protocols or in automated market makers, right? I think that we are going to see the transferability and the utilization of assets just grow exponentially. Today, they just sit in an account for most people,
Mm.
and that is going to be really seen as something of the past.
Right. No, it's actually very telling that we even at Arna protocol when we started building out, and the whole everything was structured around vaults, and then the ERC 4626 standard for vaults was not even out at that point in time, and now everything is being built around vaults. Vaults are becoming like the core of asset management. Not, I mean, obviously on-chain asset management, but quite likely to become the core of how the entire asset management industry will operate. So it's very fascinating to sort of see how large financial institutions are also using the term vault in that context.
But I do think it's important to position it in this evolution because we've been forced to use wrappers to
Mm.
get to the collective efficiency of the system. Now we are able to move away from the wrappers because the technology, off chain technology, has advanced to the point where we can do things individually for people. And now, to me, vaults are the next evolution of that, where we move that on chain. And because it's on chain and it's operating with smart contracts, now that scale is able to extend so quickly that, to me, this is a logical progression in a trend that has already been happening for decades in the financial markets.
Right. So, if I were to kind of crystallize what you're saying about the future, it will not be surprising at all to see $20 trillion moving on chain in tokenized structures, and users mostly not even realizing that that's what's happened, right? That's what's going to be in the next half a decade or decade or so.
That is success. Success is when they don't even understand that the underlying way that their portfolio is being delivered has shifted. They just see the benefits of being on the better technology and the better utilization of assets.
Right. Sandy, really enjoyed this conversation. Thank you for being on Alpha Unhashed, and looking forward to that future, that on-chain tokenized vault future along with you.
Me too. Thank you so much for having me. Great conversation.